Thank you for attending eSpring's webinar, Asia in Focus, Positioning Portfolios Amid the Iran Conflict. Over the next hour or so, our Chief Investment Officer, Viz Nair, and our panel of investment experts will share their perspectives on the conflict in Iran through an Asian lens. There will be a Q&A session at the end of the panel discussion, so please feel free to type in your questions into the Q&A function. Let's start the webinar. Over to you, Viz.
Thank you and welcome to everyone. Today, we're not here to speculate on the military outcomes. Our focus is on how these shocks arising from this conflict could potentially transmit across Asia and across asset classes. Ray Faris, our chief economist, will help investors understand the key transmission channels, while our investment managers will discuss how these dynamics are translating into real portfolio decisions. So Ray, with oil prices currently trading at around 90, certainly earlier in this month, $90, what are the second order effects that investors should be watching out for in Asia? And what are the nuances across the region?
Well, I think the starting point is to say that without a doubt, Asia is the world's most exposed region to this particular shock. The Middle East is our single largest source of energy products, of many industrial products such as sulfur, urea, naphtha, and helium. At a basic level, a $10 move in the price of oil sustained over the course of the year cuts the region's current account balance by about 0.3% of GDP. So the region at these oil prices for the rest of the year would be looking at losing something on the order of 0.8 to 1% of GDP, just in terms of a loss of imported trade. However, I think the key thing is not to focus so much on the direct exposures, but rather the capacity of different economies to absorb the shocks. In this case, China looks actually very good. It has massive oil reserves of 1.2 billion barrels. That's over 200 days. It's increased renewables as an energy source to close to a third of its electricity. It can shift to coal. Inflation is really a non-issue. It's not going to be a policy constraint. And although the government announced a neutral budget last week at the NPC, there's lots of flexibility to increase fiscal spending if necessary. All of that underpins A-share earnings growth expectations of close to 17%. If I then move to Korea and Taiwan, both are highly exposed at a superficial level to energy prices because they import so much of their oil and gas, but both have tremendous resilience. So Korea has over 200 days of oil reserves. It has a capacity to shift to coal. Inflation is relatively under control to begin with. And crucially, Korea has a current account surplus of 7% of GDP. So worst case, we might imagine it loses 1.5% over the course of the year. If oil prices are kept at these levels, it would still have a huge current account surplus. Most important, Korea, because of its position in the AI CapEx cycle in DRAM, is positioned to weather this storm very well. And that underpins Korea's amazing earnings growth of close to 78%. Taiwan is a little bit more vulnerable, but again, looks pretty resilient. The government has told us that it has natural gas in the pipeline for all the way through April and is securing more supply. It can move some of its electricity over to an increase in utilization in its coal-fired plants. It has a massive current account surplus of about 17% of GDP. Inflation is relatively low. All of that and the fact that because of foundry and the rest of Taiwan's tech industry feeding into the AI infrastructure boom in the US, again, earnings growth is underpinned at superior rates of close to 27%. If I start to look at some of the countries that are more vulnerable, the losers, they're the ones who have current account deficits and weak currencies going into this shock. So that's really India, Indonesia, and the Philippines. If I think about the first two, India and Indonesia, probably growth is going to slow, currencies are going to remain weak. India has some cushion in that GDP growth was very strong, close to 8%, and there's an urban economy acceleration that was taking place early this year in response to the fiscal and easing and monetary easing from last year. The problem is the currency, and as long as energy prices remain high, the longer they remain high, the policy regime could have to shift back to interest rate hikes to try to contain inflation in the currency. So that's how I would lay the region out. It's all of us are exposed, but some countries, particularly North Asia, are just simply better positioned.
Thank you, Ray. And as we listen to you, do you think this skews the region to a growth risk or more of an inflation risk?
I think the way to put it is that we thought we were very close to the bottom of the interest rate cutting cycle before this shock. Now we're really quite confident there won't be any more interest rate cuts anytime soon in any of these economies. There are one or two where I can imagine you might need to hike rates. I said India in a prolonged high interest rate environment in order to control the currency, but I think most countries will manage to avoid interest rate hikes. The real concern is going to be currency transmission of the higher import bills for energy into currencies. The deficit countries, India, Indonesia, the Philippines, are most vulnerable. And in terms of growth, I think from an investment perspective, this tilts toward North Asia, where they're either very strong domestic sources of growth, China, or a particularly special position in the global AI infrastructure boom, Korea and Taiwan.
Thank you, Ray. And are there any factors this time around that mean that Asia's better positioned, say, than perhaps those previous oil shocks?
At this magnitude of shock, a little bit less. I mean, it's tough to say that Asia is necessarily better positioned intrinsically. I think the key difference between today and some of the past shocks is really the global background. The fact that global growth went into the shock fairly robust. The huge AI infrastructure boom in the United States has lots of domestic funding for it. It is probably going to be very inelastic to higher energy prices. It won't really change much. And Asia is the best positioned region in the world to feed into that, to supply that U.S. Capital expenditure cycle.
Thank you, Ray. So I'm now going to turn to Sandeep, who looks after our value equity strategies. So Sandeep, periods like this are uncomfortable for investors. And so this is essentially where the time, really the period when you need to retain that long-term focus. So how has your discipline, which sits at the core of your process, guided your decisions in this recent conflict?
Stay calm, stay unemotional. There are lots of unknowns right now in the market. The duration of the conflict, how widespread it is, and how it concludes. And on top of existing uncertainties like AI software and China and private equity, etc. Whenever there are so many uncertainties, markets tend to get emotional. Markets tend to get behaviorally biased in terms of greed and fear and herd instinct. And all this creates large dislocations between price and value. It's important to understand that companies discount years of cash flows and business earnings power. Whenever there are these uncertainties in the market, it creates opportunities. And we would, in a very disciplined way, look at these opportunities to see where are we getting paid to take on these risks. In our world, in Asia, what we understand well are these Asian businesses, their earnings power, their long-term drivers of businesses, and what is implied in the share prices. And to give you an example, oil is moving significantly intraday and over different days, often double digits. However, if you think about long-term demand and supply of oil, as well as cost of production, as well as spare capacity, you would come to a conclusion that these moves are more emotional and unjustified. And several companies in Asia, particularly the downstream companies who are users of this oil, are now getting significantly beaten down with the share prices collapsing. And that could be an opportunity for us in the long term, as these companies have, through cycles, shown an ability to earn high sustainable returns. So I would say stay calm, stay unemotional, and focused on the fundamentals.
So Sandeep, I can hear this long-term focus in your investing approach. Does the conflict change any of your long-term structural views, your structural themes, or is this simply cyclical volatility?
Let's take a step back. Before the conflict, what were the structural drivers of Asia? First one was capital expenditure was accelerating in most parts of Asia, which is good for medium-term earnings growth in the region. Second was a very strong global trade cycle. Exports, which was initially AI-driven, but more recently, even the non-AI parts have started to show good momentum. And the third structural driver was corporate value up, which was leading to higher shareholder returns. So now, how has this conflict impacted these themes? We will only know depending upon the duration of the conflict and in what ways it unfolds going forward. However, taking a slightly medium-term view, maybe a 2-year, 3-year view, I think the capex angle is unlikely to get derailed. In fact, capex can have now an additional leg, which is in the form of energy efficiency, energy self-reliance, and diversifying sources of energy. Most countries in the region have now seen good cuts in their consumption, and they don't want their population to suffer another round of such cuts in the next few years. And that will drive higher capital expenditure. Remember, Asia has entered this with very strong balance sheets, both at the government level and at the corporate level. And therefore, I think capital expenditure in Asia will continue to be reasonable. Corporate value up also is unlikely to derail. Why? Because it took a long time for management teams to be convinced to return shareholder, and now there is both a top-down and a bottom-up effort and incentive to maintain that. Yes, board of directors are going to pause till the conflict concludes and then get back to the shareholder return, which is driving ROEs and hence. So I think that structural themes should continue. The trade cycle might get affected because of global sentiment getting affected, and the AI is protected because AI is largely driven by a few hyperscalers in the US who are better protected. But I think the non-AI trade cycle might pause, and that would be, I think, earnings negative for Asia.
Thank you, Sandeep. And moving on from Asia ex-Japan, I'm going to talk to Max. Max leads is portfolio manager for Japan equities. So, of course, we're talking about energy, and Japan is one of the largest energy importers in the world. Of course, that means we need to understand how energy prices are affecting Japanese corporates. And in terms of opportunities, are there Japanese companies that are better able to absorb this energy increase prices?
Thanks, Viz. I think we haven't really talked about Japan so far today, but Ray, for example, was talking about the various strategic reserves that various Asian countries have, and Japan actually is at the top of the list. It has the biggest. It's almost 9 months of strategic oil reserves. So the other thing about Japan in terms of LNG is most of it comes from Australia and Asia, Australasia. So I think we have a bit of time, and the key really in terms of the impact and different industries and et cetera is, how long these events last and how long the disruption will be. But I mean, if you look at the Japanese market so far this year, and yes, in the last couple of weeks it's been down, but it's still, up. I think the Nikkei Topics is up about 5 or 6%, even in US dollar terms, year to date, which is better than the US. And it's better than a lot of the other countries in Asia as well. So I think, and when you look at the market in Japan, the kind of sell-off has been kind of knee-jerk reaction, if you like, to the war, has been pretty well across all different sectors. Yes, some have sold off a little bit more than others, but generally it's been pretty widespread. So, our kind of conclusion at the moment anyway is that people are not worried about particularly, Japan as an individual country or Japan as a domestic economy. It's more the concerns are global and widespread, and it's really early days to kind of know what the kind of longer term impact may or may not be, or how long this whole thing goes on, as it were.
So Japan has had a fabulous run over the last few years. So a good, obvious question to a Japanese investor: does the conflict change your long-term conviction on Japan? And does it threaten the recovery of wage growth and capex that we've seen in Japan?
Okay, well, so the things you're talking about, wage growth, capex. I mean, I would add to that kind of reflation, and also improvements in governance and this kind of thing. I mean, if you really dig into the roots of where these come from, they're largely demographics based, and the fact that it's an irony really, but because of the aging of the population, the workforce, the working age population is shrinking quite sharply, which is leading to labor shortages and reflation, and Japan has been able to escape from deflation because of that. And then also I think the focus on governance and improved returns really reflects a country that, first of all, they need a strong stock market because there's more and more pensioners in the country. And they need, a highly profitable private sector that's going to pay lots and lots of tax to the government, because the welfare bill is only going to go in one direction. So, these structural changes in Japan, if you like, they're going to happen whatever happens in the Middle East. I mean, they're kind of baked in. So yeah, it's hard to really change our view based on what's happened in the last 2 weeks relative to the kind of underlying structural dynamics in Japan, which is what is really attractive. Yeah.
Thank you, Max. I think we've heard from Sandeep and Max, and I think that really the message around equities is very much long-term and discipline, helping to deliver some strong returns. And I think that that's clearly the message from our investment teams. So now we're going to switch asset classes. We're going to first go to Ron Ren, who is head of macro and thematics in our fixed income team. So Ron Ren, currencies have been a strong driver of returns in your total return Asia strategies. So how are you thinking about currency risks today?
Yeah, thanks, Liz. Typically, the dollar actually catches a bit during geopolitical disruptions like the one we are experiencing right now. So for context, since the beginning of military escalations on February the 28th, the dollar index has rallied by about 2%. At the same time, the Asian currency index has declined by less than 1%. So I think this speaks for the resilience of Asian currencies. Even for some of the more vulnerable currencies, which Ray has actually highlighted earlier during his discussion, they've declined by less than 1% or even 0.5%. So this is a combination of the strong Asian macros, which Ray has highlighted just now. And in addition to that, we have strong policy smoothing that actually undergoes when we have this sort of market-driven disruption. So this lends stability to the asset markets that are actually Asian-focused, which I believe actually reinforces this theme that we have been hammering on to our clients. That is, Asian assets are actually generally very resilient against the broader global context.
That's a strong message, Ronwen. So, of course, periods of geopolitical risk argue for shorter duration. But, of course, we're also talking about the long end. So do you see parts of Asia where growth risks argue for longer duration and making those more attractive? And what about the energy shock, energy price change effectively? We heard from our strategist earlier, but what is the outlook for Asian central banks?
Yeah, so broadly speaking, I would say that in the course of the last 1 to 2 weeks, with the onset of military escalations, we have seen across government curves, be it DM curves or Asian government bond curves, inflation risk being priced in. So yields have backed up both in the short end as well as the longer end. I'll argue that yes, there are of course genuine inflation risks arising from perhaps oil prices being 15 to 20% higher in the medium term. But at the same time, I think that to a certain extent, depending on the duration of this oil shock, energy shock, a significant part of this has already been priced in. And back to what Ray has shared earlier as well on the macro setup. Towards the end of 2025, many of us, including myself, were arguing that perhaps the curves in terms of the yield compression made valuations a little expensive. So what this repricing has done is to recreate value in the curves for carry strategies to actually do better and to create better entry points for investors at this point in time.
Thank you, Ron. And so really I'm hearing a story of Asian bond resilience actually during this period, which is of course important for investors, again, to bear in mind when they think about investment opportunities. Thank you. And I'm going to now move to Nupur, who's our head of total return and income strategies in our multi-asset team. So in Eastspring, our multi-asset strategies, we of course are thoughtful around protecting on the downside as well as capturing the upside potentials. So heading into the conflict, how has your risk management overlay, your risk management framework helped portfolios?
Yeah, thanks, Viz. So our risk management framework is really focused on being proactive. So we don't really react to specific headlines or specific events. So going into this conflict, when VIX index, the volatility index, the CBOE volatility index was in its high teens in January and February, we actually put on equity hedges to protect against any market dislocation or market volatility. It wasn't really specifically targeting geopolitical tensions. We naturally didn't expect this to escalate in the early part of March. But those hedges, in a proactive sense, helps to cushion some of the multi-asset volatility that we otherwise see. Along with that, we have been investing and diversifying multi-asset 60-40 traditional portfolios towards gold. We do think that over the last 9 to 12 months, gold as an asset has become a very critical part of strategic portfolios. And especially in an environment where geopolitical tensions potentially increase the risk of a stagflation or inflation risk across the world, we do believe that gold does act as an inflation hedge. Just to highlight that, since this beginning of this tension, SPX index, the US equities index, is only down 2 to 3% from its peak. So we haven't seen as much of a wobble. A lot of the wobble has happened in the momentum names and areas that year to date had performed very well and dislocated, as Ray highlighted. A lot of the North Asian equity markets and economies that should be relatively resilient from an earnings standpoint actually have seen the largest drawdowns. And so we think that a lot of that is more of a positioning washout. So from a risk management standpoint, keeping on those equity hedges ahead of the event has probably helped us.
Thank you, Nupur. So many questions come from me just listening to you talking about protection with gold, protection with overlays. But one traditional approach in multi-asset is think about scenarios. So what sort of stress scenarios are you looking at today, and how are those affecting or influencing your portfolio positioning?
Yeah, so great question, right? Stress scenarios, extremely important. The assumptions behind the stress scenarios, even more important. So for us, the key scenario that we're looking at and stressing our portfolios across is a prolonged increase in energy prices. Again, not taking any specific view or forecast on how long or how deep this escalation can go, we do need to ensure that the portfolio is stressed against different possibilities of oil price. At the start of this year and even in February, Goldilocks was pretty much the narrative in the market. There was some inkling that there may be an inflationary shock coming in, but I don't think anybody in the markets, especially in the macro world, expected such a large inflation shock. So if the prolonged conflict leads to an increase in energy prices that then drives a stagflation narrative to become more front and center, then that of course derails a lot of the multi-asset kind of proposition, right? The traditional multi-asset proposition. So I would say that stressing them and stressing the correlation as well, in case if you do get a 2022 redux, again, that's not the base case at all. And we do believe that we entered the conflict with very strong fundamentals on the macro side, globally speaking, and particularly in Asia, to the resilience that Rongren has just spoken about. But since you're asking me about what stress scenarios we're doing, those are the places that we're stressing.
Thank you, Nupur. So we started this webinar really talking about the fact that we're not looking at military outcomes or anything like that, but as portfolio managers, as investors, we need to think about scenarios, opportunities, and these are the moments when long-term investing really comes to the fore. We've heard from Asia ex-Japan team, from Japan team around the opportunities this brings, and of course a very clear articulation of the risks that we are considering and taking into account. Ronren has talked about the resilience of the fixed income markets, and in multi-asset, the way we think about the risk, not that we know the outcome, but we need to think about the risks and the scenarios and how we actually position portfolios. So initially, of course, first things first, investors who want to listen to us more, hear more, please do contact us, because we have those portfolio managers who can talk about how we influence portfolios. But now we're going to actually go to some questions we've received from the audience. So I'm going to start with Ray. So are markets pricing Asia as one big energy block?
Pricing, I think, has been quite diverse. So China has outperformed. It's outperformed the rest of Asia, it's outperformed emerging markets, and it's outperformed the US in absolute terms. In contrast, some of the strongest economies and strongest earnings stories, Korea and Taiwan, have, over the past week and a half, done very badly. They are still up year to date. They're still outperforming quite substantially the United States year to date. But they were the places where portfolio managers, going into the shock, had large profits, had liquidity, and so were able to use those as buffers. I look at that and I tend to think that we'll get to a stage where that underperformance stops and we revert to the earning strength in those markets that I referred to earlier. In contrast, some of the countries where there's a fundamental vulnerability in terms of current account deficits, weak currencies, they have suffered, but they arguably haven't yet fully priced a prolonged energy shock and could suffer some more. Within all of that, though, that's thinking about indexes, countries as indexes. Within each of these countries, of course, there are different sectors and stocks that can actually benefit from high energy prices. So in Malaysia, in Indonesia, there are companies that will benefit from a higher energy price. So the real focus across the region is less about thinking of investment as index plays and much more about intelligent selection of assets to invest in, both in the short term and as opportunities emerge and babies get thrown out with the bathwater for longer term investment in high value plays as well.
Thank you, Ray. So again, at Eastspring, we've talked a lot about Asia as not being homogeneous, as being a number of distinct opportunities. We hear about North Asia. We have other opportunities in the ASEAN regions. They're all quite different opportunities. So at Eastspring, we're always talking about, when we think about Asia, think about active, think about those opportunities in those different markets. So leading on from Ray's answer, I'm going to turn to Max. So with the oil, this oil shock, as we call it, how is it going to actually impact the fiscal agenda of Takaichi?
Right. I mean, I think talking about the oil shock, of course, it may have a kind of short-term economic impact, but in the longer run, I think that there's going to be no change to her kind of desire to stimulate the economy, and in particular the domestic economy and consumption and that kind of thing. And I guess the obvious question that, there's a lot of talk, and we believe in the Japan team, a lot of misunderstanding about, Japan's debt to real GDP or real debt to GDP, and also the net debt and this kind of thing. So, long story short, that's a very, very big topic, which thankfully we don't have time for today. But I would say that Japan probably, it's actually near fiscal primary balance forecast for this year. Now, of course, a macro slowdown can change all that, but do they still have some wiggle room to stimulate the economy? Absolutely, yes, they do. Yeah.
Thank you, Max. Anyone who wants the 1-hour version of that answer, you can drop Max an email.
You can refer to Ray then.
So, Sandeep, as a long-term value-based investor, are you seeing any particular mispricing or opportunities today?
Coming into the conflict, we were excited with the opportunity set which Asia had to offer, given there was premiumization, there was strong cash flows, and there was a corporate value up. And where we saw the maximum opportunities was in the North Asian consumers. And the reason was twofold. One is tech has done very well, AI did very well, and that caught the attention of a large part of the investor base, and therefore flows were exceedingly going towards tech. That meant uncrowded, not loved positions in the rest of the market. And that was our picking spot. Bottom up, great companies having high free cash flows. Particularly in China, where property has led to a significant sell down in consumption stocks over the last 6 years. But now we are in the 6th year, and we think a lot of fear and pain is already in the price. And that offered us opportunities of being able to buy marquee brands at very low multiples. What this conflict has done is essentially throwing, as Ray said, a lot of babies with the bathwater. And now we are finding that the opportunity set for us has actually increased. So what are the new sectors which have now come into? One is the supply chain companies. Because of all the disruptions globally, these stocks have got beaten down. Second is downstream companies who are users of upstream energy, like gas companies in India. What they have got beaten down and are starting to price in is years of low returns. But if you are able to take a view that this conflict could end this year, then there is significant upside, as these companies have shown pricing power in the past. One area where I think the market is overly excited are some of the AI thematic plays in both Taiwan and Korea, which are discounting into perpetuity significant demand acceleration and returns to stay high. But they are ignoring the fact that now companies are reacting to the good demand in the form of higher capex and supply. Back to us.
Thank you. Thank you. So Ray's talking about a heterogeneous market, different opportunities in different places. You've got Max and Sandeep talking about the opportunities again, but of course investors in the current environment think a little bit about risk as well. There's some caution. And the natural first stop when you're worried a little bit about risk would be go to fixed income. So Ron Ren, are there any safe havens in the bond markets?
Yeah, so Viz, I'm going to make this argument that Asia is the safe haven. So it's the safe haven in the EM world, it's also the safe haven in the DM world. What I mean by that is that if you think of, duration beta in the DM world as a 1, Asia is probably a half. It has been proven back in 2022 when you had the Ukrainian energy shock and also accompanied by strong policy rate normalization across the world. That was when Asian bond curves were actually the most well-behaved, which means that any resulting drawdown in Asia, it was significantly less. And we are likely to see similar price action right now. And let's go back to the blue chips of the blue chips. For example, in Singapore, it's definitely one of the top-notch safe havens that we can actually have in the world right now. It's a real AAA, if I may add. And on top of that, it's been proven again and again that the carry returns are decent, yet you do not suffer from the fiscal concerns which other markets actually have even at this point in time. So in that context, I would say that within pockets of Asia, you are going to have strong performances, outperformances, even in a challenging environment. And maybe one interesting thing I will point out is, even amongst the high yielders, the high bond yielders in Asia, the likes of Indonesia and India, I'll point out that these two markets were the best performing markets during the policy rate normalization cycle in 2022 to 2024. So this says something about the strong risk-adjusted returns of Asian fixed income.
Thank you, Ronren. So, of course, our investors, our clients, can imagine great opportunities in equities and great defensive protection from the fixed income Asia opportunity set that you present. Turning to Nupur as the multi-asset fund manager, your job is to think about those scenarios when the correlations that we expect, if risk assets come down, we think our bonds help protect us. So what happens when correlations break down in these sort of periods? Where do you see diversification working for you in the multi-asset portfolios? And how else are you building that resilience? I think you referred to it a little bit earlier, but we can just go through that again.
Yeah, sure. So when equities and bonds have a negative correlation, it helps multi-asset. I think is definitely a key diversifier for our multi-asset portfolios. Along with that, we have seen a lot of different strategies that are non-beta that add and do well in environments where the correlation turns positive between equities and bonds. These include quality stocks, dispersion, long dispersion stocks, and also long rates vol. So we've added these in the portfolio in order to give that diversification and that resilience. Again, we don't expect it to completely eliminate volatility in the multi-asset portfolios, but at least it helps you to ride out any potential drawdown while you can seek for opportunities later.
Thank you, Nupur. The next one's quite a hard question, so I think Ray deserves this one. Ray, what's your base case scenario for Asian economies in 2026?
Got it. But
Predict the future.
Yeah, predictions are always difficult, especially when they're about the future. Before I do that, let me just say one thing that comes to mind listening to our various portfolio managers. And it really comes down to what Nupur was just saying about diversification. So the multi-asset team tries to diversify that portfolio, but investors can benefit from thinking about their own portfolios as needing different types of investment to diversify. So before this shock, tech was all the rage, was performing very strongly. At the level of a factor, it was all about growth and momentum. And that has swung completely, in reverse to weakness. And the things that have performed well in this shock have been low volatility strategies and yield strategies. So they may not have been as sexy going in, before the shock, but they've really benefited portfolios in terms of cushioning them through shocks. And that they exhibit one of the key things that we typically argue for, which is having diversified portfolios rather than just simply chasing the current, high octane theme. The base case for Asia was good growth, focused on North Asia as the main beneficiary of the US CapEx cycle, because this CapEx cycle is very IT focused. The other theme was recovery in the urban economy in India, and with that, an improvement in Indian returns. If I think about this shock, I'm still very comfortable with the idea that the US capital cycle is going to remain strong, and that North Asia, that's Korea, Taiwan, a lot of Japan, actually, and some elements of China are going to benefit from that. India now is a little bit riskier, and how that plays out will really depend on how long energy prices remain high, whether the central bank needs to come in and reverse the rate cuts of last year in order to protect the currency. We're not there yet. I tend to think we won't get there, but that's one of the key risks.
Looking through, are we good for a couple more questions? I can see a yes. So, Max, as a result of this heightened geopolitical risk, are you more inclined to have greater exposure to domestically oriented companies? Or do you see global exporters as offering a better risk reward?
Okay, well, so first of all, if you look at the existing portfolios, we're pretty well, in terms of the kind of split between domestic and exporters, we're pretty well, balanced and evenly spread as to where we are. And to be honest, we're not making that many, or we're making hardly any changes to the portfolios at the moment. As I said, the kind of correction in the market so far, at least, has been pretty evenly across the whole market. And then within what you'll find within industries and within segments is that in this kind of environment, people will either sell, like Ray said, their hot winners, or they will sell those companies that are perceived to be the kind of weaker one in the industry. Because I think if history shows us that if you have a prolonged recession in pretty well any industry, then it's usually the weaker one that kind of loses relative strength. So, in terms of the kind of hot, high octane, AI plays and this kind of thing, because we again, like Sandeep, are kind of long-term value investors. We don't tend to own those, and also because we're long-term investors, we tend to have a bit of a quality bias in terms of sustainability of the businesses we invest in. So, I think we're reasonably happy with the current portfolio, and then the key, obviously, is going forward, and it's really very early days, but I think. If you look, we've got since these strategies, the Japan strategies were started, we've had 20 years or so and gone through a whole bunch of different really big macro shocks. You had the global financial crisis and the earthquake and COVID and et cetera, et cetera. So I think history shows you, if you look at the performance of our strategies, that these kind of big external shocks are actually, again, as Sandeep said, they're great opportunities for acquiring new names and new stocks and new ideas, because the market will pretty well sell everything off indiscriminately. So the key is to find those stocks, for example, which I guess people think are weak and have sold off, and to use our kind of long-term view and fundamental research to really separate the baby from the bathwater. I don't know, can you say that? Anyway, I think everyone knows kind of what I mean. So it's in that way it's an exciting opportunity, but let's see how events unfold.
Right, I think I would just say we need to have a peak bathwater comments now. I think we're done with 3 of our fund managers using that. Thank you all very much for joining us today. I think from my perspective, I'm hearing a lot of opportunities described. Within eSpring, some of our equity strategies have 20-year track records. They're talking about the history of different periods of turbulence and how the investors can navigate that with sort of a strong discipline and a long-term focus. And when we think of fixed income, we're thinking of the resilience of Asian markets. And don't just think of Asia, resilience in a global context. So fixed income Asia markets, Ron Wren is describing that as a global defensive play. And then again, Nupur is running global portfolios, and those global portfolios need to think about not just the returns, but the correlations, the downside risks, and all of those scenarios that we try to model and focus on to build resilient portfolios for our clients. Thank you very much, all of you. Thank you very much for joining us today. We look forward to seeing you next time.